It is a privilege to welcome David Allen, co-founder and chief investment officer of AlbaCore Capital Group, to AIC Conversations. Mr. Allen, can you please give us a brief outline of your background and career, as well as the history of AlbaCore Capital Group?
Sure. And by the way, thanks for having me on the segment today. So I've been investing for about 3 decades. Started investing when I was a teenager. I guess it would be in the 80s. And then my first job really was working as a stock analyst, a securities analyst for Jerry Dotson at the Parnassus Fund in San Francisco in the late 80s. Then I moved to Morgan Stanley for about a decade. I started in the M&A department and then ended up in the high yield group towards the end. I joined GoldenTree around the turn of the century, spent several years there, at which point I moved to London. And then more recently, I've worked for the Canada Pension Plan Investment Board, where I ran a fund, a $2 billion pool of capital for them in Europe, and started AlbaCore about 4.5 years ago. And today we manage $7 billion of assets under management with about 50 people focused on Europe and opportunities in Europe in the credit markets.
Okay, fantastic. And as you said, you began in M&A and investment banking before specializing as a high yield media analyst at Morgan Stanley. What prompted this transition?
Sure. Well, I mean, the first thing was I went to the M&A group because I thought that was where I would learn how to value companies, because I was doing that as a student in university. And I worked with some great bankers, Joe Perella, Bob Greenhill, Paul Taubman, were all mentors of mine. But I quickly realized that probably a couple of years in, that while M&A was a great place to learn how to value companies, we weren't obviously investing capital. We were advisors and advising companies. And I really was desperate to be an investor. And so there was an opportunity after the fall of Drexel, Burnham, Lambert in the, I guess, 1990, when Milken then went to jail. Many of the Wall Street firms started junk bond departments because Drexel, with the vacuum created. And what was happening at Morgan Stanley was they had fixed income traders trading junk bonds. But of course, as you know, junk bonds are more correlated to equities than they are to treasuries. And they were kind of, not sure how to trade these bonds. And they sent a message throughout the firm asking for maybe people that wanted to join the department at an early stage when it just started. And they specifically wanted someone who could value companies. So I thought, well, I'm an M&A person. I'd been doing this for a few years. I know how to value companies. And I joined the high yield department to analyze distressed companies. So when credits or bonds traded at 50 cents or 40 cents, my job was to figure out what the business is worth, how many cents in the dollar, and invest capital for the firm. By about the mid-90s, I did that very successfully. In fact, one of the first things I did was buy a bond at 2 cents that we recovered 30 cents. It was a 15 times money on Fokker Aircraft, the Dutch aircraft producer. But then by the mid-90s, the U.S. economy from 1991 recession basically expanded for about a decade. And so by about 95, 96, the distress opportunities were drying up. And I saw an opportunity to go into the media space. There was a lot of consolidation in television and radio. And there was also a new industry, which was the internet and data and digital television, which I'm sure, a lot of the students will probably have been maybe born then. But in early 90s, you had analog television only on cable. And then by the late 90s, you had internet. So there was a huge amount of capital that was being deployed, a lot of activity. And so I focused on that sector. And then when I did it, I also was, had become the #1 rated analyst, because one of my philosophies is whatever you do, just try to be the best at it. So I did that, and I ended up being #1 rated institutional investor all-star in the cable media sector.
Okay, wow, very, very interesting. And how did your experience at the Canadian Pension Fund, where you worked at the European Credit Fund, how did that inform the founding principles and strategy when you went on to found AlbaCore?
Sure. Well, it was quite unusual. I'd been working, so I got my first opportunity to invest capital at Morgan Stanley on the high yield department, and I enjoyed that. But really for the next, I guess, in my career, for the next over a decade, I guess 12, 13, almost 14 years, I worked for someone. I was working for someone else. And so I was an employee of somebody, as an investor. And I really wanted to kind of have my own thing, to have my own opportunity to be an chief investment officer or to run a portfolio really on my own. And so I had an opportunity when I left GoldenTree. I'd been in Europe and I left GoldenTree. in 2009. And then in 2010, started a fund for the Canadians. And the opportunity for me was really having the first opportunity to have my own pool of capital and invest how I saw fit. And I think one of the advantages was I was working for a pension fund where ultimately people say buy side, but the buy side maybe is hedge funds or private equity or credit funds. But really the money comes from another level up, which is the pension funds or the sovereign wealth funds. And so it was an opportunity which very few people in my seat actually get, is to work for a pension fund or a sovereign wealth fund where the money actually comes from. And we manage money for the people of Canada. It's 20 million citizens that contribute into the pension fund. And I guess, what was really instructive to me was the focus on capital preservation. The motto of the fund is to maximize return without undue risk of loss. And also I saw it from a, firsthand perspective, how, because Canadian pension planners, large LPs, how LPs see GPs. And that really helped me to set up a company that was very much LP focused, that was focused on the clients, that was focused on the product, that was had an emphasis on capital preservation. It was also the first time I'd focused on ESG. The Canadians were at the forefront of ESG. Even back when I started in 2010, I'd never heard of it, to be honest, never implemented it. And so we spent as a team over half a decade implementing, and it actually helped our returns. We returned better than people that didn't employ it. And so that really helped me when I started AlbaCore to utilize all the different factors we were considering while managing money for the Canadians.
Okay, interesting. So it sounds like you had kind of perspective on both sides when you went on to found AlbaCore.
Exactly.
And when you did found AlbaCore, you touched on this briefly, but how was the role of founder different from being purely an investor or fund manager? Were there any particularly unexpected challenges in forming a company, managing people, the associated tasks?
Yes, it's very different. I mean, in a way, there's some comical things that make it different, like, starting a business with no revenues and trying to find workspace or buy a printer or buy paper, and, focused on all the small things in a business just to get it going, I started basically alone. I had one of the founding partners, Matt Corey, joined me quite early, but it was the two of us, finding places to work. I was in a venture capital incubator for a while, kind of borrowing a desk. First week we showed up, we were wearing suits and ties, and my friend who runs the venture capital incubator said, "Dude, you're really making me look bad. Can you please wear t-shirts and jeans? Like everyone else around here is not wearing t-shirts and jeans." Because it was kids just renting desks that were doing startups. So, the startup, it's a bit scary. I was writing checks every month, for everything. I mean, there was no revenue coming in. So as an employee, again, I mentioned I'd been an employee from, the late 80s, where I worked for Jerry, and then to Morgan Stanley, then GoldenTree, and then for the Canadians. So, you don't worry about who's paying the electric bill. You don't worry about the heat. You don't worry about the printers. If the printer is broken, you ask someone to fix it. So being a startup company has those challenges. And then, running a company, one of the things that Jack Ma always says about, leadership and about running a company, he said, it's really hard. It's really easy to get people that are not smart and dumb people to work well together. They're very friendly. They work well together. Getting really smart people to work together is hard, but you want really smart people around your business. And so one of the things obviously is managing a team, attracting, recruiting talent, and smart people. You want people that are smarter than you in whatever they do, but they don't always work well together, or they can, reputationally. I'm sure you've heard of this. Big egos, confident people. And so that's really the challenge. And what can really lead to success is if you can get smart, motivated, hardworking people to work well together, it's an extremely powerful combination. And so that's really what is very different about being an entrepreneur and a founder. And then, at the same time, I'm still an investor. I'm a chief investment officer, but the role of being an employee versus being an owner is very different.
And in terms of that, creating an effective team and being a strong leader, what sorts of qualities do you think can help you in leadership? And to what extent do you think those qualities can be developed? And to what extent do you think those qualities are innate?
I think some are probably innate. I mean, one thing about one of the nicknames I have at AlbaCore is Steamroller. or I have very audacious targets and very audacious goals. When we started, and again, similar to what I did at Morgan Stanley, when I became the media analyst, the previous media analyst I think was ranked 17th ranked, and I said, well, why don't we become number one? And so, oh, well, this guy's done it for years. It's impossible to be number one in media. So and so good. I said, well, why not? Let's just try to be number one. And we were number one, within 18 months. We launched our CLO business last year, and I said, let's be number one in that. They said, oh, there's 63 people doing it. It's our first, and we're number one there. So I think one of the things you do as a leader, if you have a vision and you have, audacious goals, if you set them, and by the way, I have accomplished those historically, in different roles. I have been able to accomplish certain things, and at least try. At least if you're not number one, if you try to be number one, maybe you can end up number two, number three, versus number 65. So I think it's a good leader, is confident, is probably optimistic, drives the team, but then you have to give the team the resources. So if I say I want to be number one in, let's say, CLOs, but we need certain systems or software to get there, I'm going to deliver the systems and software. If we want to, if we need to train people or hire people or have resources available, you can't, get to the moon and back and launch the mission without the equipment and the technology that you need. So it's about setting goals. It's about, having a vision and then delivering the resources, the people to get there. And I also say to give people credit and to really share in the success. So you want to be a leader that if there is success, it's shared both, I guess economically, but also, psychologically, you share success with people and you praise them if they've done well and really reward people and make them, make them feel part of the business and part of the success of the business.
Okay. And when you were, in those early stages, you were wearing the T-shirt, you were going into rent the desk, and you were thinking about what kind of team you were going to build around you. What were the qualities that you were looking for, and is that different from the qualities that you look for now in terms of a quote unquote 10 out of 10 hire?
Yeah, there's a couple of things. I mean, one of the people that helped me when I started with a bit of mentoring was Howard Marks, who obviously started Oaktree. And one thing we talked about is, hiring people. I mean, one easy thing to do is hire people for a long time. So if you look at Oaktree, Sheldon, whether it's Sheldon Stone or Bruce Karsh, have worked with, had worked together with Howard Marks for many, many years at Citigroup, I think, and then TCW, then Oaktree. So the first port of call in terms of hiring people is, do you know anybody that you've worked with, that you know them really well, that, aren't sick of you yet and want to do something new and fun and exciting? And so I ended up bringing with me, the AlbaCore, the core investment team is from the Canada Pension Plan Investment Board. So we'd worked together. Gosh, I guess now we're on our almost 11th year, I guess, with Bill and with Deborah, almost a decade working together. Matt Corey, who's my COO, we've worked together almost 20 years, and maybe 20 years now. He was my analyst. When we were number one rated media team, he was the analyst who was doing the some of the models and the macros to print out our weekly research reports. So you have, known quantities and people that just have, will deliver and you work with for many years. The other place you look is maybe young people. So if you don't necessarily want to hire someone you don't know who's worked for 20 years, you could, but there's a risk to that. They may be doing things the way that he or she has been trained and they've been doing things for a long time. And it's hard to teach an old dog new tricks, whereas it's much easier to teach young people. So we tend to hire, I like to hire, I guess, great athletes. If you look at, Manchester United, the class of '94, which is the famous football class, which was David Beckham and Scholes and a bunch of players that ended up being, Ryan Giggs, they ended up being a great team. They were very young out of the academy. And so when I think about AlbaCore, we kind of think a similar model, which is, can you get very good athletes, very motivated people, very driven people, train them, mentor them. I'd rather spend 6 months training someone who doesn't know exactly what to do, who's a really good raw resource and a good athlete, than to take someone who's maybe going to be 80% as good, but they know how to do it right away. I'd rather invest the 6 months or the 3 months to train them. And you look for things like learning curve. You look for people that, like the key qualities are probably curiosity. Is one key quality, like, why should we do it this way? Another quality is someone who wants to get better, who's constantly trying to get better. You know, if you think about athletes, like Tiger Woods is like that. He always wanted to get better. Kobe Bryant was like that, always wanted to get better. And I always tell the team, if everyone gets 1% better, we have 50 people, that's 50% better, or whatever. You know, I don't know if that's the exact math of it, but it's a lot better if everyone's slightly better. So people that are kind of always looking for a better way to do things and always looking for faster, quicker. Sometimes those people, I would call them, some people say they're lazy people that try to figure out shortcuts, because part of life and part of business, if you can find shortcuts to do the same thing faster, that could be because you're lazy, because you don't want to work 7 hours and you don't want to work 1 hour. And in fact, you know, one of the great qualities of Matt Corey, who's my COO, is when we were doing the research back at Morgan Stanley, finding really quick ways, shortcuts to produce research, you know, through macros and through automation and through technology and through data sets. So I think some of these factors, again, someone who's driving towards efficiency, curious about things, wants to learn. Also, the other thing that's very difficult to get in a combination is a bit of humility. So when you have these other qualities, sometimes you end up with arrogant people, and that's a really bad quality for investment. If you're investing, you've got to be humble. You can't be arrogant. And the last thing, quality that is helpful, can be helpful, is a little bit of anti-authority. You know, someone who's willing to go against the grain, who's willing to be unpopular, who's willing to be a bit different. Going against the crowd is very important in investing. It's not, you know, you wouldn't want that in a doctor, right? You want the doctors to do everything the way they're taught. No. But for investing, if you know you do something different than 90% of the people, you can actually make a lot of money by doing that.
Okay, so it's kind of that competitive spirit and willingness to go against the status quo, and actually, who comes to mind when you were talking about, you know, the tenacity and the humbleness is someone like LeBron James, who's, you know, an absolute workhorse and yet is humble and a leader.
Yeah.
And I'd like to touch on your rowing experience as well later on in this interview.
Sure.
Changing course to the changing world. So you're from the United States, and the United States can be a culturally insulated country. However, your career has taken you across the globe. So why did you opt for an international career, and how has that career influenced you?
Sure. One of the advice my dad gave me when I was quite young, and I started investing, I guess, at age 14 in equities and stocks, and then, you know, went to California. You know, you were asking about university before, and, you know, I'm from Boston. I went to school in California, which is about as far as you can go from Boston without leaving the country. That was like about as exotic as you can get. And that was, you know, for those of you, of your listeners or students who travel and know the United States, you will know that Boston and San Francisco are very different culturally from each other, and it's a great eye-opening experience. And one of the things my dad said, you know, when I was starting my career was, when you're young, you want to open as many doors as possible. You want to learn as many things. You want to understand as many things. You want to work for as many different mentors. That's why I mentioned, you know, some of the great M&A bankers. I would volunteer to work for, you know, Paul Taubman or for Joe Perella, because they were well-known bankers, and they all had different styles, and so to work for different people. And it was 1994. I had been in a 2-year program, which used to be the case. It used to be a 2-year program in the bank, and then you left. You went to business school or you went to a PE fund, but you didn't stay. There were very few people that stayed at the banks. It was quite unusual. And they had something called the accelerated career path, which I was, I guess, had applied to or had was able to do because I'd been successful. And what that allowed you to do was stay at the firm. And sometimes they would send you overseas. So when I was interviewing after 2 years in M&A, the classic thing all my friends had done was to go work for a PE firm. So I interviewed with a very well-known PE firm. It's quite a famous one now. I won't say the name, but I got as far as the final round, and I had kind of the final day, and I had an offer. And I was going to do the sell day, where then they sell me. They say, you should join this firm, and you're going to have a great career as a private equity executive. And the very last meeting was with a very senior a partner at the firm. And he said, so you're Dave, you know, nice to meet you. And he said, please close the door. He said, I understand you have an opportunity, because I told them I had an offer to go to Morgan Stanley, Hong Kong, because Morgan Stanley wanted some of the talented people from New York to go to Hong Kong or go to London or go to different, there was an opportunity in Johannesburg, South Africa, but to go somewhere outside of the headquarters and then help train people or, you know, bring some of that the skill set to those markets and those regions. And he said, I understand you have an opportunity to go to Hong Kong, and you're considering coming here. He said, let me tell you something. And he said, he closed the door. He said, you should go to Hong Kong. I said, but aren't you selling me? He said, no. We're going to be here, next year, the year after. If you come here to the private equity fund, you'll have a different experience. But how different is it than what you're doing? It's your principal versus advisor. But if you go to Hong Kong, you're going to have a life experience that's very different. Your life's going to change. And, if you call me in a year and you do a year in Hong Kong or 2 years out there and you want to come back, I'll take you back. But you're going to have an amazing experience. You're going to learn about the world. You're going to see the world in a different perspective. And this particular private equity executive had worked himself after university as a reporter for a while, traveling the world as a reporter for Time Magazine. Okay. And so I left I was shocked he said it and really surprised. But I said, if this guy's telling me to go do it, I should just do that. And it probably is a good opportunity. So I went back to Morgan Stanley. I said, I'd like to go to Hong Kong. And it did change my life. I think, living in Asia, I remember the first thing I do is get a map because they said, well, you're going to go on a business trip to Jakarta. I didn't know where Jakarta was. I didn't know where Kuala Lumpur was. I didn't understand, the languages and the culture and how things worked. And I ended up working a lot of my time in actually Indonesia, in Jakarta, Indonesia. And it was just a tremendous experience. And it was basically the way I thought about it was I didn't go to business school. This is like my business school, but someone's paying for it. They flew me out there. They paid for my apartment. I had the most beautiful apartment overlooking the harbor on what's called mid-levels. And I really enjoyed it. And I spent time traveling and I spent time learning about Indonesia and Malaysia. And I went to Tokyo for meetings and business trips and for deals. But I also learned a lot about the United States. When you start to leave where you're from, and then you look back at it from a distance, it changes. It's smaller, it's different. And as you said, about the U.S., it is quite provincial. It can be, and I was from Boston, which is a very provincial town, really, and very culturally uniform. Berkeley, California, also pretty culturally uniform. And then going to Asia was a really tremendous opportunity. And so that was something that opened my eyes. And then from that point, when I came back to the U.S. and there was an opportunity later to work in Europe. When I was a media analyst, one of the things that I thought was interesting was all the activity in Europe around the media space. So cable television was just being built, in the UK in the 90s. What is now Virgin Media was Telewest, Diamond Cable, NTL, other names that were all consolidated. But there was an opportunity for me to travel a lot. So I started even by the mid 90s doing a lot of things in Europe, and then eventually moved to London, and now I live here.
Okay, yeah, and so in moving to London and founding, a Europe-based and Europe-focused firm, why did you decide to do that? And also, how is the investing environment, particularly in the credit markets, different in Europe from the United States?
Yeah, well, first of all, in Europe, I just like living here. To be honest, I think London's the greatest city in the world. I enjoyed New York. I enjoyed living in Hong Kong. I enjoyed living in Jakarta. I enjoyed living in Berkeley and Boston. But I love London. I think it's a great city. I think it's got one of the most diverse cities in terms of culturally diverse. It's safe. It's comfortable. I think there's a good balance of urban and rural. Just outside of London, you obviously have a lot of farmland and I think versus New York City, which is a comparable city in terms of international stage, I like London more. I think it's a more livable city. I've got kids, so I love living here. Also, I think the work is more interesting in a way because again, U.S. is one country, one jurisdiction, one language, one culture, maybe two cultures or three, but it's similar, right? It's all similar. And going on a business trip, or investing, if you're in New York and you're going to Philadelphia for the day or going to Fort Lauderdale, it's not that different than really what you see in New York. But if you're in London and you're doing business in the Nordics, or you're doing business in Italy, or doing business in Germany or other parts of Europe, it's really interesting. It's more interesting, and in a way, it's more challenging. It's more complicated. You've got more variables that come to play, but it also makes it there's more of an opportunity to outperform, I think, and to produce alpha. And so what I found was, having come here early in the 90s and then living here in the 2000s with GoldenTree, and then for the Canadians, I found that, this is now over 20 years in Europe, 25 years investing here, that I could, there was a scope to outperform and to do well here versus the indexes versus the market, which is harder in the US. And so all those combination of things, I love living here, lifestyle, the complexity of the continent, the how interesting it is to see different parts of it, and the ability to also invest well here. I thought all that made sense to stay here, and that's why we're here.
Right. Okay. And so obviously you went overseas, and then you ended up here in London. Many people from overseas end up going to the US.
Yes.
And the US has had, particularly tumultuous 2 decades. Do you believe that American dream that many people move to the US to pursue and have historically done so, do you think that still exists?
Of course. Yeah. I mean, look, I think if you think about, well, particularly in some segments like technology, for example, if you look at technology, how many people have moved to the US to start an app or a platform or work in technology in Silicon Valley, and now other parts of the US, and have kind of quote unquote made it, that come from all over the world. There's still a tremendous ability in the US to be entrepreneurial. And if you look at the amount of venture capital money and how easy is it to get backed with a startup in the United States versus Europe, it's much easier. You've got a much bigger ecosystem. Now, part of it is you have a huge market, right? So if you have a product or an application that works and you roll it out into the United States, you're talking about rolling it into the largest economy in the world, huge footprint, one rule of law, one country, one language, one nation under God, as they say. If you do this in Europe and you're in Germany or you're in Switzerland or you're in Italy, you're developing some product, it's harder to go pan-European. Now you can do it, it's harder. And so I think that that's why you see the big tech companies, the platforms, for the most part, develop out of the United States, because you have this huge advantage, which is a huge playing field and ocean of consumers to go attack. And English is a global language, unlike Italian or maybe German and other languages here in Europe. So I think that American dream is still, alive and well, and particularly for certain areas. But at the same time, it doesn't mean that you can't do this in other places. And I think Europe is an excellent place to start a business. I think our business probably, it was easier to start it in Europe than to start in US for asset management and what we're doing in credit opportunities, because in Europe there's less competition. If I'm in the US and I'm starting a credit opportunity business, an asset manager, there's 50 or 60 firms that maybe look similar to us, on a list. Whereas in Europe, there's fewer of them. So for me, for asset management, actually Europe was a better opportunity. But for sure, if you have an amazing platform or technology, US is a great place to go.
Okay. And now changing, of course, to AlbaCore's philosophy. AlbaCore is a deeply value-driven firm. Can you speak to these values, and the roles of these values in a firm? And following from that, do you think that investment managers should be leaders in social causes?
I think so. I think Milton Friedman did a disservice many years ago. This thing called the Friedman Doctrine, which is that basically the responsibility of business is to increase profits, to maximize shareholder profits. Greed is good. And I grew up, I guess, in Wall Street in the 80s, and obviously a lot of the books of the time and the films of the time would reflect that. I don't think it's right necessarily to just maximize profit. I think that U.S. capitalism probably in the 50s and 60s was a better model, which was, if you worked at a company for 20, 30 years, you got a pension, they took care of the workers, they took care of the environment. I think just running business for profit is not how we look at the world. It's not how I think the world should operate, because ultimately we all operate within a community. We're here for some period of time on Earth, and then we're leaving. And I don't think that we want to maximize our resources, as a sole responsibility of the corporation. So I think that values are important. I think how you treat people, how you treat, particularly as you asked before about working for the Canada Pension Plan Investment Board, working for a large limited partner, essentially for a big sovereign fund. allowed me to see more what mattered to them and what practices they like and don't like, and how to treat your clients, essentially, because I worked for a big client. And so I think how we run AlbaCore reflects that. We care a lot about clients. Success for me is, in terms of the business, is not about, making the most profit for the business, but it's actually, do we deliver the best returns for the investor? Like, is our product the best product? And that's important to me. Obviously, then, the firm profit will follow that. But ultimately, the first goal we have in terms of our product is to deliver the best return to the investors. Then if you look at our staff and how we treat people and how I think about the business as a CEO of the company, we want this to be a good place to work. We want it to be the best place to work. If I'm hiring top people and they're excellent at their jobs and they're working well together and we're building something, then I want them to be happy working here. I don't want them to be looking over their shoulder, like looking for the next thing. Right. So we try to make it a good place to work. And that means having the values that you mentioned, you asked about, but the teamwork, respect for others, diversity, et cetera. And then I think on the social causes, you're seeing now more and more companies, I guess, dipping their toe into social causes. It is probably more of a role, as corporations get as big as governments in some cases. You look at the large tech companies, they're bigger than some economies. They probably have responsibility more than just making a profit, but also doing the right thing.
Okay. And as to those ESG considerations that you touched on when you were talking about the Canadian pension fund, at AlbaCore, how are those considerations integrated into your investment strategy?
Sure. I think it's, the Canadian model for ESG is more about risk lens. So if you think about, credit investing is, you've got a fixed rate of, a fixed coupon. So you're going to get an interest rate, and you're going to get your money back. And if you buy that at 80 cents, you're going to make more than the coupon. But ultimately, the risk of loss is great, because if you have a portfolio of credits, and let's say you buy a lot of credit, 80, 90 par, and you have a mix of credits, if one or two doesn't work, you don't have that 10x or 5x to make up for a loss, right? Because you have an asymmetric security, which is basically going to trade between 0 and par, which is 100 cents. And most of credit, performing credit is going to be 90 cents, 100 cents. Today, that's roughly where it trades. So the risk of loss is much greater, is much more acute for a credit manager portfolio than for an equity manager. An equity manager can afford 1-0 if they get Facebook right or they get Amazon right. And so I think the first thing we think about ESG is the lens on identifying risk. And one of the simple things, just common sense, if the world is valuing certain things, environmental, social, governance factors, if the world values that, and the community values it, and your clients value it, and your customers value it, if a company is not behaving properly along those lines, it's a risk that at some point that will come back to haunt them, either lost customers or reputation or actual loss from like lawsuits or litigation. So the first reason we use it is really to understand risk. And so I think, and that eliminates certain companies that maybe are big polluters or that are irresponsible, because again, that can lead to lawsuits or fines or issues with solvency. So that's the main thing we look at. There's certain areas also that we can have an impact. So we often go into in the private deals, we may have areas of concern or areas that we think can be improved, and we will then monitor or will be influence those over time. So we may invest in a company it's not perfect, but it's good. And there's a few areas that they're trying to fix or tweak over time. And then as a lender and as one of their counterparties, we can then over time monitor that and help them get to where they need to be.
Okay, fantastic. And following to what you were talking about previously about having a diverse team, what is your ideal firm culture, and what role does the team need to play in that? And how important has it been at AlbaCore to recruit a team with diverse backgrounds?
Yeah, I think it just kind of comes. I mean, if you, so we don't have, I don't have quotas or any kind of, specific targets. Now we do have, I think as of today, I want to say 43% of our staff is women. We're at very high end of diversity. And we have people from, I think, 17 countries, like the last time I looked. So it's extremely diverse, I think way above the average in credit and CLO managers. But it's not the goal per se. our goal is to hire, to interview everyone basically and find people that we think would fit in with AlbaCore. But diversity is a benefit. If you think about, a quilt, a mosaic where you've got, different types of people coming into a business, having a diverse group of people with different viewpoints is helpful. And I think, if I was to take an extreme example where a business, let's say an investment committee was 10 white men from the United States, I think everyone would agree if you took 5 of them out and put in 5 Europeans even, it's better. If you then took, 4 of them out and put in 4 women, that's probably better as well, because certain sectors or certain things you're looking at, maybe you're looking at products that are just sold to women. How do 10 men from the US understand the product? Maybe, potentially could be an issue. So I think as you think about, adding elements of diversity to a team, I think you're always going to you want more and more viewpoints. If you're curious, and I'm a curious person, I want to hear, our investment committee, if someone has an issue or someone has a question or someone, wants a challenge, we're open to that. We want to hear like why we're wrong, because again, that goes back to humility. A firm that has a humble culture, that is a bit worried about things or open to hearing about risk, will be more likely to listen to a diverse viewpoint. And again, that's how I think our team has done very well over the years and become exceptional. And we have diversity because we value it. But also the other point about diversity is it's not enough just to have a diverse team. You actually have to listen to people. So you can imagine a situation like, well, we have 40% women, or we have X% minorities, whatever you ratios you've hit, but are you listening to them? Do they have a voice at the table? Do you have you have a round table about a certain issue? Is everyone at the table that needs to be there, and is everyone being listened to? So I think also listening to people and having diversity is really the combination that works really well.
So it's kind of avoiding that that approach that some firms will take, which is just meeting the quotas to meet the quotas, rather than meeting the quotas or not even meeting the quotas per se, but having a diverse team because it's ethically right and it's also advantageous from a strategic point of view.
Yeah, I think mostly the way I look at it, it's mostly it's advantageous, I think, to have different viewpoints. I think that, and on our team, we haven't hired anyone because we had a quota. We hired everyone who we thought was the best person for that role. But as I said, if you have 2 people that are identical, like if you have 2 twins that are exactly identical, and then let's say again, 10-person investment committee, and 2 of the members are identical, they're exactly the same viewpoint on everything. Well, what good is a second person? Maybe swap them out for someone who has a different view. And that's really the point, is that I'm trying to find people with different views on things and also who are not afraid to speak up. Because again, the point is you can have diversity, but if the people aren't speaking or not being listened to, what good is it? So it's also about having them have a voice and listening when there's different views. So I think that's right.
Yeah. Okay. That makes a lot of sense. And in terms of investment strategy, kind of changing course again, AlbaCore is a leaner firm, and what's the advantage and disadvantage of being a leaner firm versus some of the larger places that you've worked at personally?
Sure. First of all, it's very funny. If you told me when I started this in my career, like or started investing in the 80s, that a $7 billion asset manager would be considered a small firm, it's just kind of funny. So yes, I guess within credit, within the credit world and the global world we live in, 7 billion of assets under management, I guess, would be considered small. Really, when you step back, it's very large, but it is not as big as Oaktree or GSO, now Blackstone Credit, or Ares, that are 100 billion plus. I think if you look at size, what is the result you're trying to deliver? So if you're trying to deliver the best returns, then, well, let's say differently. If you're trying to deliver the most revenues, then you definitely want the most AUM, right? So this is a mathematical formula. Revenues times a fee AUM times your management fee equals revenues. And if you want to maximize revenue, and that's your only goal, then you want to be as big as possible. So if you look at the large ETF players, for example, Vanguard or BlackRock, they just they're big. They're trillions of dollars, because every extra trillion is more revenue, and that's better for the business. In terms of then the question of, what are we trying to deliver? Are we trying to deliver the most revenues to AlbaCore Capital, the GP, or trying to deliver the best returns to investors? At this point, and the goal set out was to deliver the best returns to investors, then you definitely don't want to be managing $1 trillion or $500 billion or $100 billion. Because if you think about, sitting around ranking your best ideas, and if you have 7 billion of AUM, maybe 70 ideas can go 100 million each and they can invest the capital. All of a sudden someone said, here's another 93 billion. Well, then you have to have a lot more ideas. So what are your ideas from 0 to 70? You know those. What are the ideas from 70 to 500? And maybe they're not as good. Maybe the 500th idea is less good than the 70th idea. So there's clearly an advantage to being, let's say, smaller, as you say, leaner, more nimble. But then there's a level where you're too small. So I think where we wanted to get to, I call it the kind of Goldilocks. If you're very small, then you're not a market participant, you're not a market player, you can't provide a private solution to a company. You may not be big enough to be relevant to capital solutions trades or to providing the banks with liquidity when they need liquidity. So there's a big enough and too big. And I think where we wanted to get to was, big enough to do any kind of private deal and be relevant, which we are now, but small enough to outperform, which we have done historically, and make alpha versus the market.
Okay. And following from that, I mean, AlbaCore follows a really unique hybrid strategy. You guys tend to move kind of seamlessly through public and private credit markets. What's the origin of this, and what's the advantage of it?
Yeah, I just think it's common sense. It's almost like I was speaking with someone who drinks wine, and imagine someone who just drank French wine, or someone who just drank Italian wine. Clearly, there's some Italian wine that's better than the worst French wine. But if a French person says only French wine is good, and by the way, I'm sure we all know people, and I'm sure your audience, they know people that would say that, like French is the best wine, Italian the best wine, whatever, and they're probably from those countries. But obviously, then being able to pull from both France and Italy, you're going to make a better wine cellar by having the best of both countries. That's diversity, right? So when we look at credit and in investing, just because a company has a listed security or they don't have a listed security, that alone doesn't change the probability or propensity for them to default, which is ultimately, we're trying to avoid defaults. We're trying to get the most return and the highest rate of return, projected rate of return, without having losses from defaults. And so again, if you think about a public company, a private company, or listed security, there's not going to be a difference really in how those act in terms of whether the business pays back its debt or not. So it's kind of common sense to me to combine both. Now you're going to ask the next question: why doesn't everyone do that? That is obvious. It sounds right. Why doesn't everyone do that? And the reason everyone doesn't do that is when you get so large, again, like the large asset managers, then they tend to silo people because they can't have one large fund of 100 billion. They have to have 10 different funds, and this fund does public loans, and this fund does junk bonds, and the other fund does private lending for small companies. This is private lending for large companies. This does mezzanine fund. It does mezzanine lending, and so you end up with silos. Because again, if you're trying to grow revenues for the asset manager, you want as many specific and differentiated products as you can. And when you have as many specific differentiated products that you can, to raise as much money as you can, then each of those is run by a different person that has a focus on private mezzanine deals or term loan Bs, loans, or junk bonds. And it's unusual to put them together into one vehicle, which we do, but it's very beneficial. And if you look at our performance and historically how we've done, it's been, for us, very clear that that's important. But again, not for everyone, not just because people silo, but also the other thing I'll say is not every private market participant feels comfortable in a public market environment. So many people like to buy something, like in private equity or private credit. Sometimes you buy something and actually you don't know for 2, 3, 4 years if it was a good investment or not. There's no price, you can't tell. You can see your revenues going and you can see cash flows, but the market's not telling you every day if you're smart or not smart. When you're investing in liquid markets, it's quite humbling because markets fluctuate. You buy something today, and next week the market will tell you if you're smart or not smart, if it's up or down, and you'll feel that pressure. And I think, again, a lot of people separate those because it's different. We put them together We've done that historically for since we were at the Canadian Pension Plan, and we feel comfortable, but we're also pretty good at it doing that. Not everyone can do it.
And to that last point, and this is slightly going off the script, but that, working in liquid markets, it sounds quite high pressure, quite a lot of volatility. You have to be okay with being uncomfortable. And previously,
Yes.
talking about that competitive athletic mindset, where you have to be okay being under pressure. Is there is there a particular kind of person who tends to gravitate towards public markets versus private markets?
Well, don't forget, I also said someone who's okay to be differentiated or anti-authoritarian, right? So if you think, let's say the market's the authority figure, right? And you buy something and in a week the market says, oh, that was a bad investment. Well, you might say, I don't care what the market says. I don't take what the market says. This is not, ultimately value is value. I'm going to find out in, 1, 2, 3 years. And I don't care what everyone thinks, because essentially the market in the short term is like a popularity contest. It's like how many likes you get, right? It's like Instagram or Twitter, like likes. And the near term movement of the market is based on likes or dislikes. Something becomes in favor, it's out of favor. Last year Tesla became very popular, so the stock went up a lot. The earnings didn't go up anywhere near how much the stock went up, but the stock went up because it was popular. And again, things go out of favor as well the other way. So I think the kind of person who's suited well to public market is probably someone who doesn't worry too much what everyone thinks, who doesn't get too anxious about the daily fluctuations, because the market will fluctuate. If someone asks me how's the market going to do next year, I always say what JP Morgan retorted years ago: we will fluctuate. We don't know where it's going to go. It's going to go up and down. But longer term, if you're buying things that have fundamental value, you can make good returns. So I think it's someone who's okay, again, to be where the crowd tells them they've done something wrong, and they're okay to be, go against the crowd for some period of time. And that was a great example. Last year in March, obviously, in the market crashed. Anyone buying at that point was going against the market. It was going against the popular belief, which is things are really bad and going to get worse. And that takes some kind of mindset that is okay to look wrong in the short term.
Right. Okay. Yeah. And touching on the COVID-19 market crash, you've been an investor in several crises. You've been in Black Monday in 1987, the Thai baht Russian crises, 97 and 98, and the global financial crisis, among others. What lessons have you learned from investing in those periods, and what was unexpected in the COVID-19 crisis?
I mean, I think again, the biggest takeaway is the market will fluctuate. The market is volatile. It's inherently unstable. The market is an unstable place inherently because there's no one controlling the market. So I think if you equity markets, if you know that, and the market's inherently volatile and inherently unpredictable, you also would understand that the market can get overvalued and get more overvalued, and can be cheap and get cheaper. It doesn't. There's no rule that has to be fair value. In fact, the market's rarely fair value. It's going to be either rich or cheap at any given time. And so the most important thing really is, if you think about how you get wiped out and how you get really hurt in investing, is really two things. If you use leverage, so if you buy assets and you lever yourself, and your leverage is what's called mark-to-market leverage, which means it's like margin leverage. So the bank will call you on any given day when the price moves, and you become a forced seller. This is pretty much the recipe. It's a very simple two-step process. Over-levered, market moves, you have to sell. And you have to sell. It's required by the margin, by the bank, because they hold the securities. And then you crystallize your loss, and you're out of money. You've lost all your money. So, and this has happened in another, example with the housing crisis in the U.S. If you bought 3 houses and put a bit of money down, the house price dropped, the bank took your house, you lost your equity. So there is an ability, unfortunately, with margin lending to get wiped out and be a forced seller. You just want to be the opposite. So knowing that, you want to kind of be the opposite, which is, I never want to be a forced seller. And in fact, if the market is in a position where people are being liquidated, I want to be a buyer.
Right.
If fundamentally the market's cheap. Now you could have margin calls, and you got the market dropping, which the first part of when the dot-com bubble burst, it took over a year for the market to kind of get to the lows, like 18 months. It wasn't right away. So the first drops actually were followed by further drops. And if you go back to the great financial crisis, that also was the case. But again, the most important thing is being in a position where you can purchase assets cheap if they're cheap and not to be a forced seller. And then you asked about whether this was different. I mean, I would just say they're all different. Like every crisis, there's a crisis coming now. There is a crisis that will come to the markets and will cause the market to drop 20 to 30%. It's on the way. It's already probably the seeds of it have been planted, and it's coming soon to a theater near you, as they say. And it will come, and anyone who enters that period of market crisis with maximum leverage will have to sell into that crisis. And that's how it goes throughout history. And knowing that, and then you don't know when it's going to come. That could be next week. It could be 1 month from now. It could be 1 year from now. It could be 2 years from now, but it's coming. And if you go back, the students can look, at the 1962 flash crash. It's called the Kennedy crash, but it was really caused by just a random movement of the market and margin calls. But it's a great lesson. And the market basically rebounded within 3 days back where it was. But it moved, I think, 20% or 25% very quickly, and then kind of back up again, really for nothing. And people try to find reasons afterwards, but sometimes markets can move really for nothing, because once you get markets going lower and people get scared and they've got margin, they will sell.
Okay. And a lot of this brings to mind a quote from you that I read, which was, patience has a way of making everything very cheap or very rich at some point, which I liked a lot. And bringing it to AlbaCore specifically, AlbaCore's $1 billion dislocation strategy, which is invested quite early, I believe it was in March, quite early in the crisis, has marked returns of 50-odd%. How was AlbaCore able to be in that position? And how were you able to move that quickly and still make informed decisions?
Sure. So the first thing was, sometimes in life there's a bit of luck to this, what we're doing. And I'm not going to say no one at AlbaCore knew there was a pandemic, that there was a respiratory virus coming in 2020. However, just having been doing this a long time, it was clear that in 2019 the market was had been running for a long time. It had been gone really since the sovereign debt crisis in 2012, which even Americans kind of forget that, but it was obviously big in Europe. But many people would just say the only crisis, the big one was 2009 and 2008, 2009. And so we're kind of 10 years into a cycle, and we're worried about recession or about a downturn, various things. And we started speaking with investors in 2019, and just by chance, I think it was around Valentine's Day of 2020, we signed up a lot of capital for that, which basically, and our thesis was, or our pitch was, if you look back at history, we have data going back to 1981, was then called the Salomon Brothers Index. It's obviously Salomon Brothers is gone now, but you go back and put indexes together, and if you look at the market over 30 years of history, almost 40 years of history, I think 38 years we looked at, you do find certain triggers where the market's cheap. Where basically, if you buy the market, and let's say the market with a capital M, you buy every security in credit and high yield credit, that you always made money. It happened 5 or 6 times if you have a certain triangulation of spreads and dollar price and yield. And so we set up kind of circuit breakers, trigger fund that had these features that said if the market has these prices and levels of spread and yield. And of course, as you know, I would say we signed up from Valentine's Day. Within 2 weeks, the market started widening, and then 2 weeks later, it hit the triggers.
Wow.
And then your question on, okay, how do you react quickly? Because you have to I always watch the safety demonstration on airplanes, because sometimes the plane does land in the East River. You got to remember where your exit is. I just watched that stuff. My mom growing up was a flight attendant. So I guess if you're then preparing for a dislocation fund, it would be pretty irresponsible if you have a fund and you have client capital, not to have some sense of what things you would buy if the prices all drop 20 to 30 points. And I know, for example, lots of credits that we would have followed sometimes for 10 years We love the credit. There's a French cable company we think is a great credit, but it's traded at a 4% yield for 10 years or 5% yield for 10 years. It's kind of a shrug. Gee, if that got to 70, we'd buy some, right? And you go down the list. And because we have our CLO business, which I mentioned before, we launched in, I guess, last year or 2019. And we've been in Europe, in various, either Bill or myself, Deborah, for many, many years. I'm for decades. There's a lot of things we really like. There's a lot of credits we think are great credits that are in certain industries we like and that are good companies. But again, the price was always wrong. And so we had kind of a wish list, I guess you would say. And so that enabled us when the market turned and we came in one day and someone said, okay, you can buy the French cable company at 72 cents. Sure, let's buy it. The other point at that moment is what I always tell my trader, not to be cute. Don't be cute. Like, let's buy some of this. Don't be cute. Because there was a tendency also for many people to say, oh, this is the first leg down. And there's another leg down and another leg down. And people that were my age that had been through, let's say, the NASDAQ bubble bursting or the 91 recession or, global financial crisis, it wasn't a 2-month crisis. It was like a 2-year crisis, 1-year crisis. It was a slow deleveraging of the financial system. This was a very fast margin call. It was a very quick deleveraging margin call, and people were forced sellers, as I mentioned. But there weren't a lot of people that were going in leverage because people had learned some lessons from '08. But there was on the margin several $1 billion that was, billions and billions, probably tens of billions, that was on margin. And then equities, of course, can run on margin very easily. So I think the other point, when we looked at the market and fundamentals, once things fundamentally seemed cheap to us, cheap to fair value, it would be nice if you thought there was a second leg from 70 to 50 cents to wait until it got to 50. But what if it doesn't? And by the way, it didn't. The punchline, the spoiler alert, the market moved pretty much from the lows almost straight up over 3 or 4 months. Half the gains were captured, and then the next probably 4 months, the other half of the gains were captured. But from 70 cents to par, there was about 6 weeks probably at the beginning, and really at the lows, maybe 2 weeks. And so the other thing we really think a lot about is, and I tell the team is, if something's fundamentally cheap, does it really matter if it's going to get a little bit cheaper? And are you comfortable not buying it here and taking the risk that it doesn't get a little cheaper and it just goes to fair value? Because things that are at 70 that are worth par, or maybe they're worth 95 and they're at 70, it's a disequilibrium. The tendency is for it to go back to fair value. So the longer you wait to hope it goes lower, it's like a magnetic pull to fair value. Ultimately, we'll get to fair value because some other person will arb it and say, this is cheap at 72. And so the other point I think that helped us is just having a kind of non-market timing approach. Say we can't, again, humility. We don't know where the market's going. We don't know it's going to go lower. Now, we didn't invest all the capital in the first 2 weeks. We invested a lot of it. We didn't invest every cent, but we invested a lot of capital, enough that we got pretty much at the lows a lot of the money to work, and that helped, again, as you mentioned, with the returns.
And when you were buying securities at 70 cents on the dollar, and where a lot of people, this is a general statement, where a lot of people arguing, hold off on buying it, wait till it gets to 50.
Exactly.
We're saying, yes, no, we're going to buy it now because fundamentally this is the lowest it's going to go.
Well, it's also part of, we're about as antisocial as you can get in terms of, AlbaCore Capital Group talking to other people. I remember years ago being told I had to go to these roundtable hedge fund lunches and dinners. And it turns out that it's not a great place to get ideas, because when you go to the roundtable hedge fund lunch and some person's telling you to buy something, they're probably shorting it, and vice versa. This is a cynical view, but it is the case. And people, I'm sure you watch Billions and whatever, and you understand the nature of the hedge fund industry, that you're never going to get a great idea from, that's talked about in a conference room, I don't think, with a bunch of people. So we generally don't kind of compare notes and talk to people in the market. We tend to do our work fundamentally. We talk to, obviously, traders and counterparties at the banks. We talk to companies. We visit companies. We understand fundamentally what the business does and what we think fair value is. But in terms of, comparing notes, but I know that just anecdotally, when I heard a few people that didn't invest then, the common reason was, and they were probably my age, there'd be people in their 50s who'd been through crisis say, no, guys, just wait, This is going to get worse. This is the first leg. I've seen this movie before. This is the first set of margin calls. Then you're going to get retail fund outflows, and then they're going to take prices down. You're going to get more margin calls. You're going to get people unwinding their funds, gating funds, et cetera, et cetera, et cetera. And it's going to be a 6-month, 9-month decline. And it didn't happen like that, obviously, you know. But I think that was the consensus, because we do hear, and we, you know, it was pretty lonely buying things. We were buying things sometimes with just partnering with the bank. There wasn't other people buying certain securities. But that was the opportunity at that moment. And again, it came and went pretty quickly.
Right. Okay. So it's kind of that contrarian spirit again. And
yeah,
at the beginning of talking about COVID, you said, you know, all of these crises are different. Looking back at the past year, what are you taking away as the big takeaways, the big lessons, and what are the big successes of the past year, if there can be lessons that you think can be applied to you know, future crises?
Yeah, I mean, I would say it's stuff we did, because again, I'm a more maybe veteran, having done this a long time, like going in. So again, the two things: don't be a forced seller. So just make sure that you are not a forced seller. And we carry leverage on our funds. We have some leverage in some parts of it, but we run like loans go to 40. Like we run numbers that have never happened. Now it's not saying it can't, but we have huge margins of safety against any debt we would have, or we have, you know, CLO debt, which is cash flow based debt, not mark to market debt. So the first, I guess, lesson that people will take out of this, if they hadn't learned it in '08, and by the way, because asset management is a generational game, you know, people come and they retire, and then new people come up. Not everyone was investing in 2008 that was investing today. You know, you could have some people that were very young in 2008, or that were investing in a different part of the market, or were the bankers, or doing something different that didn't necessarily appreciate that, or people that weren't around in 2000, 2001, '02. So it depends how much experience someone has, how long they've been around for. But the basic starting point is, if a 10% drop in the market is going to make you is going to force you to liquidate all your positions and lose all your money. It's not a great position to be in. This is what you saw with obviously the hedge fund that blew up, the family office that blew up recently, that's in the news. Right. Is it sounds like 10 to 20% move blew up the business, because it was very levered. That's not smart. And by the way, the stocks he owned weren't even cheap. I was looking through the stocks, you can see them now. They were expensive equities. They weren't cheap equities. So first thing is that, and then the second thing is to imagine, kind of role play. Okay, what if the market dropped 30 points tomorrow? What would I buy? What would I do? And you might run scenarios for why it dropped. Different reasons, you might do different things. So it's about, again, when you're on the airplane, like watching the safety video, it may not come in handy, but gee, it's sure good to know where the exit is if the plane does land in the East River, that it's one row behind you, not 10 rows ahead of you. So we just kind of go in and I think that you asked about leadership, or being a leader, like it's actually making sure the team understands that whatever experience I have, I can impart on them, even though they're young and they're 30 or they're 35, and this is like stuff they read in the history book. I can talk about with them informally or formally about my experience and make sure we're prepared for any eventuality.
Moving on to the next year. This year has been described as the year of the credit picker. What exactly does this mean, and what opportunities are you looking at as a chief investment officer in the public and credit markets? Sure.
I think a lot of this, so you had COVID. So one of the things we talk about, was that if you bought securities in March, April last year, the key question was, is this company going to survive? Like, is it going to go bankrupt or not? Right. So that was a key element. If you could pick companies that weren't going to go bankrupt, that was kind of at 70 cents, you can make a lot of money just saying they're going to be around for a year. Now, today you have a different scenario, which is you're having reopenings starting to occur. But, take, for example, the cruise line industry. We made a lot of money in cruise lines last year. We've sold almost all our positions now. Because today where the industry is trading is more challenging. You've got now credits that trade rich within that sector and still no revenues, right? You still don't have revenues. Now you have vaccine, But when the vaccine came out, all the spreads and yields and prices of cruise, equities and debt went up a lot. And so today, the discounting of the reopening doesn't pay you a lot. And if for some reason there's not a good reopening, or revenues don't go back where they were, or there's a fifth wave or a sixth wave, whatever wave we're on in different parts of the world, then obviously you're challenged in terms of evaluations and in terms of returns. So I think there's a more challenging analysis today. Is not just you're going to survive, because you can say Carnival Cruise Line is going to survive and Royal Caribbean is going to survive, but how will it look in a year or two? Like, how will the balance sheet look? How will the ratios look? How will their earnings per share look? And that's more challenging because small fluctuations, I'm sure the listeners know, whether it's airlines or cruises, anything with a big fixed cost base, 10% moves in revenues can be a huge material effect on net income, huge effect if you have a fixed cost business. So I think today the more challenging analysis is predicting the reopening trade. And I think that's where we spend a lot of time. But again, as you mentioned, bond, the year of the credit picker, also equity picker, there's going to be winners and losers. So if you take, probably people more familiar with equities in general, the lockdown trades, the Pelotons and Netflixes, those may be fine, but if you have change in behavior back to what it looked like before, you could lose money in some of these lockdown trades. Other companies that maybe have no revenues may come back strongly. You may have stronger than you had revenues from before. So I think there's going to be, again, winners and losers. The next chapter of this is, okay, everyone who survived goes to round two. Now round two is, what does your business look like 24 months from now? And it's very difficult to do that. We spend a lot of time on that, understanding patterns and consumer behavior and how things look and how vulnerable business models are.
Okay, right, fantastic. And now moving to more general questions. At UC Berkeley, you were an all-conference rower. And how did your experience as a rower affect your personal development? And also, how did it affect the development of AlbaCore?
It's just really hard. I mean, rowing is there's a lot of sports like this, but it's one of the most physically demanding things you can do to your body. And I was rowing at a very high level, U.S. Division I. I did some U.S. national team rowing as well, and the level of work required for this is tremendous. And in fact, when I started my job at Morgan Stanley M&A, they hired me literally because the guy said, "Well, I didn't have the best GPA." He said, "We have people from Wharton with 4.0, and I had a 3 and change, I think a 3.2. He said, "But you're a rower, so we know you're strong. You're gonna work hard. You're gonna do all-nighters. You're not gonna give up. You're not gonna get tired." And they hired me because I was kind of a workhorse, as they said, like a rower from University of California. It's definitely, in life, if you challenge yourself physically or mentally challenge yourself, that helps you to do other things that you think are challenging. So I think that's why people climb mountains. So that's why people do, difficult things. And people that do those things and have the self-discipline to go through them and be successful at them, it can, oftentimes lead to success in other parts of your life. Because whenever something seems hard, I just think, well, this isn't as hard as getting up at 5:30 in the morning every day and going and rowing on the estuary. It's also a team sport. I really enjoyed, rowing is not. I did have some, awards, as you mentioned, but ultimately the team wins or loses. When you lose, you take your shirt off, you come back in without a shirt on, and the team loses. No one's blaming someone. The team lost the race against, other clubs. And then coming in around humility and kind of losing, coming in to the boathouse on a home race, especially without your shirt, because you've lost to Stanford or you lost to Harvard, it's not a good feeling. And all you want to do is figure out how you're going to get better to win the next race. And the other thing about rowing, which is really interesting, is it's a game won by percentages. So, on a 2,000 meter race course at an elite level, you watch Olympics, you watch, sprint racing, you might have the first and second crews be within 20 meters easily, which is 1%. Right. So a crew that's 1% faster will win a gold medal. And you could even have situations where the crew that's 1% slower is sixth in a race, six regatta race. So I think it's about, hard work, humility, trying to get better, understanding that 1% matters. And I think I've learned a lot from it. And it was really probably changed my life. I think it was why I got the job at Morgan Stanley, because I thought I was a hard worker. And I think it helps me in many times when I felt like quitting or felt like I couldn't do something. That strength of of willpower and self-discipline was really came through. But look, it can be other things. People can be artists, or they can be other athletes, or great at math. It's not just sports, but for me, it was an area that really helped my life and my career.
Yeah. So going back to that, that 1%, if you lose by 1%, and failing in general, how do you think young people should be approaching failure? How should they deal with it?
I think they should try to fail. Actually, I mean, I think that I think it's very sad if someone doesn't fail, because it means they're not pushing themselves. It means they're scared maybe to push themselves, but they're scared of failure. And I think if you think about failure as a way to learn something, and a way to get better, then you kind of want to fail. If you think about even like basic functions like bodybuilding or lifting weights, like we did, when I was rowing, we did weight training. And when you break your muscle, when you're literally ripping the muscle, like putting it under extreme pressure, what happens to the muscle? It gets stronger. So the next time you lift the weight, you can lift more weights. But it's going through a process of breaking something. So I think if we think about failure as development, or as getting better, or as learning, then I think we think of failure differently. Now, and it's also much better to fail young than fail when you're old. So for example, one of the worst investments I've ever made in my life was I made a great investment, which I bought TWA equity. So in the mid 80s, I thought it was kind of cheap. It was $12, $13 a share. And Carl Icahn took over the company. About a year or two later, he bought the company for $40 a share. And the way he bought it was $20 in cash and $20 in junk bonds, and you could take the package. I felt super smart. I'd bought, maybe 100 shares, 200 shares, and I thought I'm great at this. So I ended up taking the package, which was cash plus junk bonds. And then and the junk bonds went to 70, went to 60, and they were 14% coupon, they yielding 18, 19%. I took the cash and bought more of them. So I bought more junk bonds in the mid 80s. Now, eventually it went bankrupt. TWA went bankrupt. Like many airlines at some point go bankrupt, and I was wiped out. I lost everything. And I learned that lesson, I guess, on binary businesses with high fixed cost base, business with they were susceptible to fuel prices and traffic, et cetera. But good thing I learned that at age 18, not age 48, because if I learned at age 48, I'm going to lose $200 million. I learned at age 18, I lose $2,000. And so I think that, but I still remember I will tell, my team will say, David always talks about TWA in the 80s when we look at something that's binary, because I learned a very important lesson. It was very painful to lose all my money. This is money I'd earned like babysitting or mowing lawns or paper route as a kid, as a teenager, and I lost it all. So I think that, for people thinking about as they go through their life, it's good to fail young, and you only need one time right. You can fail with relationships, you date lots of people, or you can even get married more than once, but you only have to get everything right once. But in order to figure out the right answer, you have to fail a lot. You don't always get it the first time.
And going back to when you were young, I mean, what was success to you when you were 20? And what is success to you now? And, is there a significant difference between that? And also, adding on to that, what do you think success will be to you when you're 80, let's say?
Yeah, I think again, going back to my dad's advice, like I always thought about where Andrew Carnegie talks about, splitting your life in thirds. First third, learn as much as you can. Second third, earn as much money as you can. And the last third, give it away. That's what Carnegie said. And my dad had always said, when you're young, you want to get as many experiences, learn as much as you can. Just travel and learn and work for different people if you can, and volunteer for things and just learn as much and it opens more doors. So when I was 20 and I was entering, I guess at that time, working for the Parnassus Fund as a stock picker, and then going to Morgan Stanley in the M&A department, I just wanted to learn everything. I was like, I was working on every project that came up, they said, who has capacity? I'd say, I've got time, I've got capacity. And I was working, huge number of hours a week with different bankers and learning and almost running myself like to exhaustion, because I was volunteering for everything, because I wanted to learn everything and I wanted to get better and better and keep learning. Then when obviously the Hong Kong opportunity came up, I raised my hand and went to Hong Kong, and then I went to the junk bond department, which is a new department, to go be a principal investor. Then I volunteered to be the media analyst that I hadn't done before, like first time looking at media and pick it up. So I think when I think about my 20s, probably until, maybe my 30s, even like for the first 15 years, you just want to get as good as you can at everything. And also the other philosophy I had was, if I'm doing something, I want to be the best at it. So, our team was #1 rated for media. We weren't just average, we were the best. And what does it mean to be the best, and keep trying to be the best at things? So I think that was, for me, success was just learning as much and becoming valuable, right? I made a lot of money for people I worked for many, many years. And then at some point, it's like a slingshot, you pull back all these experiences and then you let it go, and it can go really far because you have so much to offer, so much to give. I think then today, where I am is, and by the way, over the years, there were a lot of mentors. Also find mentors. If there's someone I had a lot of mentors over the years, someone who, frankly, sometimes they were mean, people that were mean. There was one guy I remember working in M&A. It was reputation was like, this is the meanest guy. He's like, yells at everyone. If you make one typo, he'll yell at you. I said, I want to work for that guy. I don't want to make typos. Who's that guy? And I worked for this particular, associate who was known to scream at people. And I said, I want to get screamed at if I make mistakes. It sounds like he wants to have the best book, the best model, the best presentations, and everything perfect. So why not work for this particular person, which I did. For many years, actually, we worked together, like 20 projects together. The guy was called Mark. Then today, I think, if I think about the mentors and my experience, wouldn't it be great if you can kind of, the elevator came up for me and I'm kind of at the top of the elevator, don't forget to send the elevator back, like to get someone else, right? So can I be a mentor to other people? Can I train people? Can I teach people? So I think for me, where I am in my career now is more about, and can I build a business? For me, it's kind of interesting to build a business from scratch and do it my way. So how do you build it my way? I've seen other people do it. I have a different view of how you should run this business and what values are important to the business. So can I build that? That's kind of a challenge. Can we be the best at it? That's a challenge. So it's about challenges, but also what's more important to me is, can I take people that are the raw athletes and make them into superstars? Can they be part of the team? And can we build a business around people? And then my success for me is, do I have great people working for me? And are the people developing? Are they getting great at their job? Are they becoming exceptional? And that would be for me success today.
Okay. That's super interesting. Now moving on to the final round, what we're going to do is called the lightning round. So I'm going to just shoot a bunch of questions at you. And if you could just respond, as quick as you can. So what inspired you as a young adult? I think it's just curiosity and kind of trying to figure things out. It probably was Arthur Conan Doyle, Sherlock Holmes character. I just loved solving mysteries. So for me, Wall Street, finance is one big mystery, right? Which I thought was like, Sherlock Holmes would be great at this, I think. I like that. Favorite book?
Okay, this is a book that actually Warren Buffett gave to Bill Gates, and Bill Gates said it was the favorite book he ever read. I read it recently. It's called Business Adventures, 12 Classic Tales from Wall Street. And again, it's Buffett gave it to Gates, and Gates thought it was great. So I thought, if you figured if these two guys love this book, I read it and it's fantastic. So Business Adventures, 12 Classic Tales from Wall Street.
Okay, I'm going to check that one out.
Yeah.
What is the most undervalued life experience university age students don't give enough weight to?
I think back to your question on risk, just investing their own money or running a business, like doing something with money and seeing, if you're any good at it. It doesn't take a lot of money to do it. I started investing when I was 14. And, from 14, by the time I was 22, I had 8 years experience investing. Who has that, right? So I think that's one of the things that's very easy to do now. And it's I think everyone should do it. If you want to be in finance one day, start when you're as young as you can.
Okay, cool. So what's one innovation or change right now in society that you're personally really excited about?
I would say some of the medical therapies, like RNA-based medical therapies, where they can change your genes. This is, I mean, really exciting, I think.
Okay, awesome. And then final one, this is quite a fun one. I like these. So hypothetical, you're hosting a dinner with 3 people, past or present, dead or alive. Who are you inviting?
Benjamin Franklin.
Okay.
I would say Leonardo da Vinci and Maria Montessori. She can help me with my kids. She's a kids educator at Montessori schools.
Yeah, a friend of mine is working at a Montessori school, actually.
Maria Montessori.
Yeah. Okay, that's cool. I like that list. All right. Well, awesome. You know, that's all I have for the questions. Thanks so much for taking this time. It's been really a lot of fun to talk to you and to hear your insights, and I'm sure it's going to be really insightful for the audience as well. So thank you again. Yeah.
Okay, great. Thank you very much.
Yeah.
Thanks for having me.